So guys, thanks for joining today. This is a little bit different than usual, but we're adapting and we're thriving and just making it work. So everybody's getting accustomed to Zoom, and those guys have to be making a mint. I know I signed up for the premium service, so good for them. But yeah, thank you guys all for joining. I think we've got some great content today. We've got Aaron Kuroiwa here, who's going to give us some insights from his perspective, from the front lines, still out there doing tours and, gloves and masks and all, and get his perspective from Marcus and Millichap. And then I'm going to share a little bit with you guys on some conversations I've been having with some of the operators that I work with, around what they're doing to deal with, basically the pandemic and all different aspects, and then kind of what we should be thinking about as investors as we look to, I don't want to say capitalize, but as we look to just, adapt to the environment that we're living in. So we'll go through that. And then what I'd like to do at the end is just have everybody, that's probably a half hour of content, have everybody just go around. Hey, thanks for joining. Have everybody go around and just do, 90 seconds with who you are, what your focus is, what your goals are, and and if you have any questions or advice or anything for the group, and we try to help each other out. That's what we're really all here for. So again, I appreciate you guys all joining. We've got about 15 people on, so it's a great group today. But you guys could have been at home. Well, you are at home. You could have been on Netflix. You could be playing video games. You could be doing God knows what. But you're here. You're focusing on real estate. You're doubling down on your knowledge, and we're going to be better because of that. So appreciate you guys all joining us today. And with that, I'll give a little bit of my background, because I know there's a lot of people on here. Open it up to a broader group than I usually do, since we were virtual. I threw it out on Facebook and said, hey, why don't we just let everybody join? Usually it's just a local Indianapolis crowd, but we've got folks from all over. So for those of you who don't know me, my name is Kent Ritter, and I run the monthly meetup here. So I'm a real estate investor. I've been investing in real estate for about 4 years, full time for the most part. I've invested in a lot of different things. I've got single family rentals. We do flips. We've got Airbnb. And primarily my focus lately, past year and a half, has switched to large multifamily, where I do syndications. So I've done a lot of different things, and in the past 4 years. So definitely have some battle scars and some lessons learned. I know you guys all do too. So I hope we can all help each other with our experience as we go through this. So with that, I'm going to turn it over to Aaron. Aaron's going to kick us off. So Aaron's a broker with Marcus and Millichap. Aaron and I have known each other for, I don't know now, maybe, I don't know if it's been a year.
About a year.
Yeah,
about a year.
Probably about a year. And Aaron and I have looked at a few deals together. Just found him to be very, very straightforward, very open, very knowledgeable. And he's got Marcus and Millichap behind him as well. So I thought that he'd be a great person to come and talk and give his insights on, where we're at, what we're seeing, what he's hearing from the investors that he's working with, and where he and Marcus think we're going to end up coming out of this. And then we could talk about things that we can do to prepare for that, right? Because I think that's what we're all trying to figure out, is how do you manage a current state, but how do you keep one eye toward the future? And how do you make sure that you're capitalizing on the current situation? So with that, I'll turn it over to Aaron. Thanks, Aaron.
How's it going, everybody? Can everybody hear me okay? Give a thumbs up. There we go. Cool. I see a few familiar faces. Kent and we've tried to get a few deals done together. I know Travis Mears. Actually, that's Zach. Look like you're using your buddy's account there, huh? You're too cheap to pony up for your own Zoom account, Zach?
That threw me off, because I was like, I think that's Zach, but
yeah. So Mike, Marty, I think I follow Marty on social media. We've interacted a few times. Alfredo, we've emailed a few times on deals. So it got nice to put a face with a name. The overall market, to kind of give you a background on myself just briefly, with Marcus and Millichap, obviously, one of the largest commercial brokerage firms in the nation. I specialize in apartments. That's all I do. Active, very active in the marketplace. And I've got listings ranging from St. Louis, Lansing, Michigan, Dayton, Ohio, and all throughout Indiana, and some in central Illinois. That's not my primary focus, but I do have some stuff there as well in the Champaign and Decatur area. I've got 14 multifamily listings right now, ranging from 700,000 to 12 million, actually 13 million. And the only reason I mention that is just to to communicate the different owners that I'm talking to, and the activity level of the feedback I'm getting from the marketplace and the communication that I'm having. The owners that I'm talking to on a daily basis, and I am calling all of my clients right now to say, how are you handling this situation? What are you seeing in terms of collections? Especially April 1st, I was calling everybody, not on the 1st, but 2nd, 3rd, 4th, what are you seeing on collections? But overall, I've got 14 listings right now, 5 of which are under contract. 4 of those are new. 2 of them are in very tertiary. I wouldn't even call them tertiary. They're smaller than that markets. And outside of that, everything else has got active offers. So despite the current situation, multifamily is still seen as the safest investment long-term. And from the marketplace that I'm communicating with on a daily basis, this is seen as a temporary blip. And I don't know if everyone else agrees with that. If I know that there's some active owners in the group, what your thoughts are. Maybe thumbs up or thumbs down. If you think this is longer than 4 months, why don't you give me a thumbs down? If you think it's shorter than 4 months, why don't you give me a thumbs up? Don't know. That's fair. Don't know is a fair answer. In the middle, okay. What in these? Okay. Don't know. It's a fair response, right? It's too soon to tell. Nobody knows. What I can say is that no matter what, no matter how bad the situation gets, at some point in the very near future, there has to be not a correction in terms of a marketplace, but life has to return to somewhat of a normal level. People need a place to live. People need income. The government can't support everyone indefinitely, right? The world will continue to turn. And so multifamily is the most essential of commercial asset types. And we're not seeing any price corrections at this point. Sellers, owners of apartments are still very confident in the properties that they have, and they don't need to sell. Certainly there are owners who overpaid that, will be feeling that more than others, but this is not 2008. And anyone who's sitting on the sidelines waiting for this, unicorn opportunity to come along is likely to be disappointed in that. Now, I don't have a crystal ball. I could be wrong, and in 6 months from now, we'll all see, and somebody can, tag me in this video 6 months from now and call me out if they like. But the underlying economics of multifamily are still very strong, and that is, we need 4.6 million apartment units by 2030. We have not been able to exceed 300,000 new units a year ever in development. And so we're behind achieving that goal by a very large margin. Home ownership is on the decline and has been for generations. Basically, each and every generation subsequently has had a lower rate of home ownership. And multifamily is fundamentally sound. 2008 was predicated by a financial collapse where lending dried up. And that kind of leads to what the current market is right now. Lending has not dried up. Now, agency lending has gotten a little tighter. There's more scrutiny. Their requirements for having more money on hand, more reserves. They want to see 12 months to 18 months of debt payment in a reserve account. Outside of that, banks, I think, are going to be the go-to at this point, at least temporarily. Fannie and Freddie terms are still great. However, that 12 to 18 month reserve account is a deal killer for a lot of people. And if your deal pencils out on a 25-year amortization schedule and you can still hit your numbers, bank debt's still very attractive because it also gives you more exits. Where a Fannie and Freddie loan, you are going to have some prepayment options, or prepayment penalties that are going to occur if you try and sell before the term is up. Bank debt doesn't have that. And so you may have a slightly lower cash flow, but you're also paying down your principal faster on that loan, which puts you in a safer position long term. You also have more exit options. So from a lending perspective, the only ones who are sitting on the sidelines and who are out are CMBS conduit loans and Lifeco. They're pencils down and they're not touching anything unless it's dead center on their bullseye of what they want. Anything or in a very, very established client. Outside of that, they're not doing any loans. Or agency Fannie and Freddie, they're open for business. The only difference we've seen is it's just a little slower. Anyone have any active deals right now under contract? Thumbs up, thumbs down? No? Okay. I've got 5 in escrow right now. I'm trying to think. If you can't see me, I'm counting on my fingers right now. So, sorry, my brain's working. Lansing. I'm looking at my deal board over here. I haven't hung it on my wall. I traded offices for one with a view at the beginning of the year, and I've been so busy I haven't hung my my whiteboard up. But of all of those deals, all of them, not a single one has died. They all still have, and they've all put the hard money even after this occurred. Their money has gone hard. So none of those deals have died in that time frame. The only thing that has changed is DD has gotten pushed out on 3 of the 5. So due diligence timeframes are a little bit longer, and that's accounting some for the banks and the lenders, not because of any uncertainty of the loan. They're just overwhelmed. Interest rates 4 weeks ago were amazing, and they got overwhelmed with refinance requests for Fannie and Freddie. And that's actually part of the reason why Fannie and Freddie are being a little more picky about their loans, because they don't have the bandwidth to take on a lot of more loans right now because they got hit with so many refinances. The banks as well. The banks are being overwhelmed actually with the new CARE Act PPE request for small business SBA loans to cover their employees. And they don't have bandwidth. So that is the main reason for the financing contingencies being pushed out a little bit. Due diligence, on the other hand, we're still getting that done relatively quickly. I was in St. Louis last week. I put a mask on, had gloves on, and I did video tours for my buyer of all 52 units. Sent that to him in a file, and we're adapting, but deals are still moving forward. Kent, I don't know. That's just kind of the high level overview. I don't know if you have any specific questions that you'd like to follow up with, or anyone who's participating has any additional questions.
Yeah, I have some questions. I'd love to open it up to the group though. Anybody out there have questions? So what are you seeing? We talked about, I guess I agree with you for the most part from a financing standpoint. I think that, CMBS, but a lot of us probably aren't leveraging those.
No,
those
CMBS and Lifeco. Anyway. Yeah,
it's mainly larger institutions, right? But we definitely like Fannie and Freddie. Yep. I agree with what you're saying. I think the banks, I'm going through refinancing on a couple properties right now, and the biggest thing is, like you said, capacity. Just like, well, it got slow. So it should have been financed like a month ago, refinanced, and it's just been pushed out and pushed out just because
Yeah.
they got a lot of stuff going on. And I'm hearing like with the SBA loans, I mean, what they're saying is, yeah, like they don't even know how to distribute them yet. They don't know how to service them. So I think, capacity will be an issue, but overall, I mean, I think you're right. I think the deals are still there. I mean, I don't know. I think some of you are on my newsletter. I know not all of you are, but one of the big things I commented on at the end of March was, in times like this, I think if you go back to the fundamentals, like to me, it's always the fundamentals. I'm a big econ guy. Did econ in college, and if you look at supply and demand, right? Like Aaron said, that stuff doesn't change. This is a short-term thing. It is a shock. It's, I mean, it's a hell of a shock, but it still and there honestly could be some extent that this becomes a new normal where, I mean, the coronavirus, like the flu, may not go away, but we'll find ways to treat it. We'll get through it. We'll get used to it. We'll normalize to it. Like you do with everything, right? You get used to everything. The world will come back. And I think, like you said, that supply and demand dynamic is still going to be there. So I think it's still, it's still good to look for. I mean, I've had a lot of people reach out to me, a lot of people that were on the fence about investing. I've been talking to about investing, saying, I mean, essentially, I'm ready to get off the roller coaster, meaning the stock market, and look for real assets. So
Yeah.
I think that if nothing else, I think that's been positive. It's going to kick in the pants for some people to say, okay,
Yeah.
like I've been talking about real estate for a long time, like now I need to go do it. And people are starting to go do it. And I think that's great, because I think ultimately it is the best way. It is the best way to get out from whatever's going on with the government and whatever's going on with printing of money. And I mean, one thing I can tell you for sure is the dollar is going to be worth less in a year than it is today. I mean,
Yeah.
it's what happens when you print money. If there's more of it, it's worth less, right? Just like
Yep.
anything else.
They're
So
printing a lot of it.
they're printing a lot of it, and they were doing it before, and Europe's doing it too. And so if you can think about assets and buying things that are inflation hedges and move with inflation, then that's a good investment, right? In the near term, I mean, and the long term. But if you think about inflation's coming, the good news about owning real estate is rent typically moves with inflation, right? So it's a great hedge. Now, you need to be realistic, and you may have to say, okay, we're not going to raise rent for 6 months or a year even. We're going to renew just to get occupancy. So we're going to renew at the current rent versus trying to raise. But I think that's a hell of a lot better than your stock portfolio tanking 30%
Or more. Yeah.
So
Yeah. I think, so what you just mentioned is interesting, because it's kind of a double-edged sword. I think, unfortunately, the best teacher is experience, right? And a lot of people who you were probably trying to get on board with investing in real estate, they're like, but the stock market's doing so well, so they would never actually pull the trigger until they lost a bunch of money in the stock market. And then they're like, okay, I'm not ready to do real estate, but I don't have any money because I lost it all.
Yeah, it's tough to have that conversation when the S&P's up 30%.
Yeah, it is, right?
But when you look over time, it's that volatility that kills you. It kills your returns.
Yeah. I outside of just doing the minimum that I'm allowed to put into my 401, or I put into my 401k tax write-off, I have nothing in stocks. I don't do stocks. And so, real estate is what I know. When the times are good with stocks, it's good. When they're bad, they're bad. But in terms of what we're gonna see, I think it's a little too early to tell. I will say this: I'm actively talking to all the owners, as I talked about. With the exception of like one or two owners, everybody across the board is saying, I'm seeing like a 3 to 5% difference in my normal collections. And that 3 to 5% are people that I need to work with in some way. They have a genuine need. They were impacted, and they can say, yeah, here definitively, here I lost my job, or I'm furloughed. Outside of that, and actually anecdotally, when I was doing that 52 unit inspection last week, it's a B class property, and 65% of the tenants were home and they had their computers on and were working from home in some way, shape, or form. And so I think that shows confidence that, hey, these people are not just sitting at home and they've lost jobs, right? They're still employed. Their world still has to continue, and their employer's world still continues. They're just adapting to the new normal or temporary normal. And so that was comforting. The other, I would say that another 20%, 25% were not home. And then maybe 10% were home and just doing nothing. Only 10% of that 52. So very few were home and doing nothing. And I really can't say doing nothing. I'd say part of those were parents who were home with their kids who, they had, and the kids were doing schoolwork. They had little desks set up and they had their program that they were following to get their schoolwork done still. So for the most part, from what I saw, everybody was being productive and working. Obviously that's going to depend on who your tenant base is and the demographics of those tenants. And outside of service industry, frontline service industry, restaurant, factories, distribution, warehouse. Mike, I know you've got a property where a lot of people work at the Amazon and Walmart distribution centers. They're probably working more hours than they normally do. They're probably getting overtime right now. I don't know if you've heard that or seen that.
Yeah, we're certainly seeing that in certain segments, right? The folks that are working in retail, which is grocery, plenty of work, right? If they're at the big box
retailer,
home improvement stores, yeah, they're still going, right? The Costco's and then the Amazon centers, those guys are working around the clock, and we certainly have some folks in that side of town that work in the medical device distribution centers and whatnot. They're all getting over. Yeah.
So interesting. You mentioned like big box home improvement. Kent, one of the things you had mentioned at the start of this is the access to data that Marcus and Millichap has, and I'm almost getting too much data. We're having daily nationwide conference calls with updates. Good information, but sometimes it's a little overwhelming with the amount of information. But I just got an email about an hour ago from John Chang, who is our director of research. And he talked about employers that are still hiring. Walmart is hiring 150,000 people, Amazon 100,000, Home Depot 80,000, CVS 50,000, Dollar General 50,000, Kroger 33,000, Albertsons and Safeway, which are also owned by Kroger. So let's call Kroger 63,000, Lowe's 30,000, Dollar Tree and Family Dollar 25. That doesn't completely make up all of the unemployment, but one of the roles I think that is going to shift for C-class property owners is being a resource for their tenants and knowing, hey, these are the resources available to you. This is where you can go for employment so you can still pay rent. And a lot of times I think people are owners are finding that their tenants don't know that what to do. They haven't had this situation. They don't know that the unemployment laws have been loosened to include people who had to take time off for their kids because their kids are out of school. People who are furloughed. It doesn't have to be you were fired, and so or that you can't get employment. Unemployment has been expanded, and for C-class tenants, if your rent's under $600 or $700 a month, well, $600 a week is enough to pay your rent, and that's still more than the 50%, the 30% requirement. 3 times, it's actually 4 times what your rent is in a lot of cases for C-class tenants. So unemployment would be more than enough for a lot of the owners who are, in that C-class demographic who is impacted the most by this. They should have ample income to cover rent and basic living expenses.
Hey, Aaron, one thing you brought up, which is something I was thinking about, is that rent to income ratio and thinking about that. And that's why I know a lot of you guys here are local to Indy. Some of you may not be, but Indianapolis. So essentially, HUD says that affordable rent is 30% of your gross income, right? Well, Indianapolis, we sit at about, I don't know the exact number right now, but it's somewhere in the low 20s. It's 21% rent to income ratio. So meaning it's an affordable market from a rent standpoint. And I think that's why markets like that will fare far better than markets that are more expensive, like in the Northeast, where you could be paying 50, 60% of your gross income to pay rent. So there's just more room to breathe there. So I think that's a positive of a lot of the Midwestern markets. I mean, a lot of folks like to invest there because of cash flow anyway. But the other big positive of the Midwest is that stability, kind of that steady Eddie approach. And that's one of the reasons, is because relatively speaking, the rent to income ratio is lower, and that makes it more affordable even, in these tough times. Now, if people are, completely out of a job, it's a different story, but at least it's more of an affordable situation.
Absolutely. And I would say that's
20%.
true throughout the Midwest.
Mm-hmm.
Look, Indianapolis is a great market. I'm born and raised in Indianapolis. And I will say, there's a lot of it. I know there's several people on this call who are from out of state. Indianapolis is a great market. I'm not telling you not to invest in Indianapolis, but be patient. Everybody wants to be in Indianapolis. It's a great place to be. People love living here. Our economic fundamentals are great, but getting deals in Indianapolis is tough, even for locals. So,
and I think it's like so what does Indianapolis have going for it though, right? We talked about rent to income ratio, which is something that you guys need to really make sure you're looking at as you're analyzing deals. What does that rent to income ratio look like in that market or submarket? Really important to understand the affordability. But what else does Indy have going for it? It has a lot of non-cyclical jobs, right? So we're a state capital. We have the county, city, state, and federal government is all located. I mean, the federal government piece in Indianapolis, or in Indiana, all sits in Indianapolis. We've got major universities. We got 3 major universities in the city. We've got and we've got a lot of hospitals, huge healthcare here. So not that it has to be Indianapolis, but I like to invest in cities like Indianapolis. So Columbus, Ohio is like Indianapolis. Kansas City is like Indianapolis. Minneapolis is like Indianapolis. Those are things that are going to help you in situations like this. Make sure that you're on the right side of things. I mean, look, I know a lot of people that were investing and are investing in Orlando and Vegas, right? Vegas, like 40 to 50% of the population is in the hospitality industry. Orlando's not far behind it. Those markets were super hot, right? They've been so hot the past year, but now, I mean, they're going to struggle while this is going on. So I think looking at that rent to income ratio, looking at the jobs, the job diversity in the market, but also of the property, like as you're looking at properties, that's something you should be looking at, is you should know what the job diversity is. You get that through a lease audit, right? You know where people work. You need to understand what your exposure is. So those are some things to look for as far as, that's why I like cities like Indianapolis, and things you need to be looking for when you're looking at properties.
Absolutely. So, Kent, I just wanted to, you had sent me a couple questions beforehand. I just want to make sure I covered all those, and,
Go for it.
and then, you're in charge here, but if anyone has questions, feel free to chime in. I'm happy to answer any questions that anyone has. Market, you had asked just about market activity in general. I think I answered that in general, but I'll just leave it at this. My phone has not stopped ringing. It's slightly less, but honestly, I don't think that's because there's lack of interest. I think it's because most people are taking a vacation right now. Everybody's at home dealing with kids, doing the honey to-do list, and doing a lot of those home projects that they may have neglected. But I would say my phone's only ringing 20% less. And of a 40-person office that's here in the Indianapolis office, I'm one of 4 people that are still in the office every day. I can't work from home. Has nothing to do with my family. They're great. I love them, but I don't have the self-discipline to work from home. So I'm in the office every day, but I could be here 12 hours a day, even right now. So demand is still strong, and lending is there. And I think that's the key. Is I was talking to one of our other very experienced brokers in the office who deals in the office and industrial side, Joseph DeSalvo. There's still sellers who want to sell, there's buyers who want to buy, and there's money to fund the deal. And if you have those three ingredients in a real estate market, the market will continue to move. Now we're getting a little creative with some of those deals, but outside of that, the market is still there and everything's moving forward. Cap rates, as of yet, we have not seen any movement. Unless seller, I mean, here's the thing is, as we talked about, fundamentally, multifamily is great. And as long as you own a property that cash flows, sellers know what they have. They're not giving that up. I got in an argument with one of the other brokers in my office. He told me the multifamily was an easy asset type to sell. And I said, you're crazy. Do you know how hard it is to get a listing? Because there's, an 85-year-old man who knows what he's got, and he's never going to let go of that property ever, because he knows how good it is. And it's a cash cash flow machine. I quote, Meet the Parents, and pry this from my Kung Fu Grip. If you remember that part of the movie when he's on the plane, but it's like prying, a precious gift from those owners. Now there's obviously different owners who transact more frequently, but 80% of multifamily is privately owned, and owners don't want to give that up, and they're not highly motivated to sell that asset at a discount unless they have to. And right now they don't have to. There's, no one's hurting. This isn't '08 where they're in the reasons people sell real estate. Does everyone know the reasons why people sell real estate? Death, divorce, distress, right? There's got to be a motivational factor, unless this is your profession and you're in the business of buying and selling real estate on a regular basis and you transact. But 80% of the owners are not. This is their income that they live off of. And so will we see an increase in cap rates? If we do, I anticipate it'll be relatively minimal. There will be opportunities out there, but I don't think that it's going to be '08. And the reason it's not going to be '08 is because there's still money that's lending. And '08 really went on for about 4 years. And there was no money to lend on deals. And during that time, people needed to sell. And in order to get a deal done, they had to lower the price. And in this situation, we're not there. So cap rates, I think at the most, we're going to see a half a point. And I think that's being aggressive. I think it'll be a quarter point adjustment at this point. Unless interest rates significantly increase, which I don't think if Donald Trump is in office, that's going to happen. So other question was,
so Aaron, while you're on that topic, just kind of thinking through that cap rate expansion process.
Yep.
April, I don't know, and anybody else chime in here, but April was pretty insignificant when it comes to debt for us. We didn't see a lot of bad debt. We collected 100% of our rents right out of the gate within the first few days. And
that's great.
Which was great to see.
Which one collected faster, Bloomington or Avon? Say Bloomington. I'm just messing with you. I sold Mike his deal in Bloomington, so I just want to.
It was good. It was done by the fourth. We were completely collected there.
But I'm good. I'm glad.
But I think our concern a little bit is less April than May and June.
Yeah, I agree.
we're really starting to talk to folks now that are saying, I can't get the unemployment turned on because there's just such a inundation of calls, and they're trying to get things set up. It's like, it's kind of like everybody going to the BMV the same day to get your license, right? They just don't have the capacity to make this happen.
And so that is a real issue. I think that the bandwidth is an issue. The money's there. They'll get it. And actually, I think that's a great segue to kind of talk about some of the one of the things that I had that I talked to Ken about talking about, and that is when someone can't pay, how are you dealing with that, right? What is the strategy? Now, I know Alfredo, you own, Mike, you own, Marty, I think you got some single families. I don't know what everybody else has. Zach's got property as well. Oh, he's changed his name back. You're not Travis anymore. And Kent, you own in the marketplace. But for those who are getting into multifamily or those who already own multifamily, I think this is an important lesson to learn, whether you already own or whether you're going to own, because at some point in your ownership, you're going to, maybe not deal with a situation that's identical to this, but something that has characteristics of this, and you're going to need to be creative to work with your tenants. So Kent will share my contact information, and I'm about halfway done with a resource guide that's going to share all of the ideas and best practices that the other owners that I'm talking to are doing, along with many of the apartment association, Marcus and Millichap, and what everyone's doing and how they're implementing those, because I think it will be, I don't know if it'll make or break, but it'll certainly make it a lot easier pill to swallow when someone can't pay rent and how you handle it, right? I think this is, in the big picture, this is short term, right? We're already starting to see some of that improvement. And with that said, we just have to get through this, right? And you want to be an owner, and I personally feel this way, that you want to keep those tenants when this is all over, right? Unless they're a bad tenant, then it is what it is. But if you've got good tenants who have historically been good tenants and they have a genuine problem, I think number one, it's in our ethical, human side of the business to work with people, right? And to find a solution that works for everybody. It's a win-win. That doesn't mean anybody gets a free ride. That means, what can we figure out that works so that you can still pay what you owe without, putting undue pressure on you in this particular situation. So just high level, some of the situations that we're seeing is we're seeing owners prorate the missed rent over the remaining term of the lease. So just like you would if you had an upfront concession and say, well, first month the rent's free, but we'll prorate it over the remaining 11 months. Well, it's just the reverse of that. You can't pay this month or next month. Well, we'll add that to the remaining months when things normalize. The second one is using the deposit. Using the deposit as rent, and having and we'll talk about policies after this, but these are just ideas, because the way you implement this is important legally, but taking the deposit and then having them sign up for a deposit insurance program, which is like $10 a month. We're seeing a promise to repay, or just extending the lease beyond that. Let me pull up my document here. I've got it. So promise to repay, lease extension, prorate, credit card. Landlords are taking credit cards as a form of payment. Deferment, which you're not prorating it, you're just deferring the payment. They're going to catch up when they can. And then a flex pay what you can, and then we'll figure out the rest, right? And then use some form of those other options to make up the balance of what is due. So a couple things regarding the application of that, though, is two things that are really important. Whatever you do, you have to do that universally. If you don't, then you get into the fair housing issues, and you can put yourself into legal issues. So if you forgive rent for one tenant, you should be prepared to forgive rent for all tenants. With two, you need to document what your standards for that policy are. So it needs to be a written policy, and you need to have guidelines for it. And that should be shared with your tenants. Three, document all communication with the tenants. If you are giving any kind of, forgiveness, concessions, flexibility, whatever that is, you need to document that process. Look, 99% of the time, you're not going to have any issues, but that 1% can cost you a lot of money, and nobody wants to pay the lawyer, a lot of money to represent them for an issue like this. So whatever you do, document it, have a standardized policy, and be prepared to do that universally for all your tenants. I'll share that with everyone. Is anyone implementing that now? Or any of those ideas? Mike, you're not. You got 100% of your money, so you're fine.
We're not, but what we have in the past, in 2008, we certainly did some of those same things, really. I mean, there was a lot of unemployment, right? So you had people that were without a job but were good tenants, and you worked with them to try to keep them as long as you can. So we've kind of been implementing those things for a number of years.
A couple things that we've done, Aaron, along those lines. One was actually coming up to April is offering a $50 discount for prompt pay, just to get the money in and kind of see where we're going to be. And the other thing, I mean, just taking advantage of those payment plans like you described. So you were talking about, kind of amortizing or pushing the owed rent back to future rent payments. So we didn't do that exactly, but just working out payment plans with people so they could pay over time. So those are two things that we've implemented. I mean, the other thing I think that's really important is just being an advocate for your residents, and like I think you mentioned it, Aaron, but bring information to them for rental assistance programs, unemployment programs, things that they can sign up for. I mean, we've even had managers, our office managers, actually helping people fill out the paperwork and sign up for this stuff.
Yep.
So I think just being an advocate for your residents. I mean, one, that's just it's an intangible amenity, right? That other people aren't providing, which is going to build loyalty for your property if you stuck with them through the tough times. And two, it's just practical. It's going to help you minimize your bad debt. So I think because of that, we were on top of this. We probably started doing that like 3 weeks ago. So we were able to get a lot of people in unemployment and into those programs before things did get backlogged. Because right now, I mean, like I've got guys on the business side, on the flip side of the business, the business of flips. We've got guys that laid off so that they can get unemployment. And like one guy, for example, he screwed up on his unemployment application. So we had to help him rectify it. But now, I mean, he's at the back of the line, and it's a big line. So so we're trying to work with him. We're probably going to give him some sort of loan or something. But anyway, it's I think being an advocate as much as you can and helping your folks, especially in those C-class properties.
Yeah, absolutely. I think that's both are good points. It's incentive. An incentive on-time payment is one of the items that I had on my list. I did fail to mention that's a good one as well. I think that's one that's case by case, right? Your tenants who don't need it, and you incentivize them to pay on time, and they already were going to pay on time anyway. Maybe you lost a little bit of money, but maybe it helps. I think that's a case by case basis of whether your tenant base, if that's going to be effective or not. And I think being an advocate is huge. One thing that I think is a little scary is that it's a little scary when the president or the governor or the mayor says, look, we have a moratorium on evictions for 3 months, 4 months, whatever that number is, right? And I think what is key in communicating to your tenants is if you have a real issue, we'll work with you, but there are no free rides, right? Yes, I cannot evict you right now, but as soon as that moratorium is up, I'll be in eviction court, and this will go on your record, and it will ruin your credit. so let's work together. I don't think that most tenants are trying, from what's being communicated by the owners that are here and that I've talked to, is that I don't think tenants want to, they're not trying to get out of rent. I think human nature is people are good by nature, right? And they want to do what they've agreed to do. There are probably a few bad apples in there, and those are the ones you're going to have to, have a firm hand with, right? And communicate that tough line, while at the same time advocating for them and giving them resources on how they can pay, versus, just creating an adversarial landlord-tenant relationship. And so, that is, there's a balancing act there, but finding a way to communicate that firm but understanding tone with tenants who do need help, I think will be key as well. While at the same time providing them with being a place of resource and advocate for them at the same time. So it will be a balancing act. I think a lot of us are learning and going through that together, as we go through this process.
Yeah, thanks, Aaron. A question for the group: Has anybody taken advantage of the forbearance or of delaying your loan payments? I actually had a commercial bank reach out to me and proactively asked me if I wanted to delay my loan payment for 3 months. So that's definitely different than 08. Right?
I would like
to
to hear feedback on that as well. But I would say be very careful with how you do that. If you don't need it, I'd be careful in accepting that, because there are usually strings attached. And especially with Fannie and Freddie, my Alec, who Mike has done a loan through, Alec told me, yes, Fannie and Freddie are offering that, but they won't tell you up front, but you're most likely blacklisted for a few years. That you will not be able to get another loan from them if you do that. So,
has anybody done it?
We haven't done it, but we were offered that both from Fannie, from the servicer of the Fannie debt, and also from our commercial banks as well. We didn't, but we certainly have taken an advantage of the rates on some commercial debt, which has come down.
Yep.
And not even had to refi, but we're able to get some rate adjustments and probably drop a point off of debt right now. Stuff that's even a year old.
Yeah, that's what I've been focusing on too.
Even if it's offered, don't you still have to go through some type of qualification process?
I think what I understand, at least from Fannie, is you did have to show distress. So you couldn't just take the forbearance if everything was operating in good standings. It was really more of a issue that you could show that there was issues in your P&L.
Yeah, I think with banks, it's more bank to bank, because the bank that I was working with, I didn't take it because we didn't need it, but they were just going to do it on the spot there. Say, yeah, you need 3 months, go ahead. The only thing they were asking that I don't collect rent for 3 months. And I said, well, now I'm going to go ahead and try to collect rent. And it's been fine. But, yeah, I think that, I agree there that, I know there's strings attached, right, with anything that you do, especially with Fannie and Freddie. I think with commercial banks, especially if you have good relationships, it could be a little more leeway there. But
yeah, I agree. I think
ask those questions, right? Like, ask those questions and be careful with it. I was just curious if anybody had taken advantage of it. I don't really know anybody that has yet. I think as we get, like Mike, you were saying, is April's kind of the tip of the iceberg. I think May and June get worse, and then hopefully we start getting out of this. But I mean, we'll kind of see what happens.
I guess the continuation of that question, Aaron, would be for you is, what do you see that impact having on cap rates, right? So if you see, the next 3 months, so we have 90 days of rough collections in certain assets, does that impact where they stand?
I would say it impacts if someone's desperate to sell. I think as an overall market, you're not going to see, I don't think you're going to see advertised lower cap rates. I don't think that there's the motivation from the majority of owners. I think if someone's certainly in a distressed situation, you're not going to know that up front. You're going to know that by talking to either you've got a deal that you know the owner directly, or you're talking to a broker who knows the situation.
Mike,
Outside of that, I think it's going to be case by case, whether or not someone is, hurting at that point in time, to be honest with you.
You might want to look at deals that were done the past year or two, like I said, in Vegas or Orlando. You might be able to find some deals.
Yeah.
That just aren't penciling out anymore.
I would, so you mentioned Vegas and Orlando, two of the highest growth markets in the entire United States, along with Phoenix being number one, Tampa. I was living in Phoenix in 2008. Phoenix, the Midwest, one of the beauties of investing in the Midwest is we see lower lows and, or higher, we have a much more even low and a much more even high, right? We do certainly see upswings. Phoenix is drastic. In 2008, I bought a townhouse. I was been married for 4 years. It was our first house, and it was a 1,200 square foot townhouse. We bought it for like $180,000. And that was like 6 months before 2008. And when at the end of 2008, or after 2008 and the crash happened, the value went to $70,000. It lost more than half its value. And my neighbor was this older gentleman who bought the property, when it was brand new. He was original owner, and he had paid for it in 1970, $70,000. So it lost in all of its value. Now it's back up, but who knows where it's probably, back down. But those markets certainly are a little bit more of a roller coaster, and there probably is a little bit more opportunistic, properties and deals out there in those markets. But I think you're going to have to be hunting pretty hard to uncover those, right? Or have established relationships. But they're probably out there in those opportunistic markets that have seen higher highs.
One thing you said, just going back to those high growth markets, that's why understanding market cycles is so important, right? Because the reason that Phoenix and Vegas and Orlando have been so high growth the past couple of years is because they were the hardest hit markets in 2008 and 2009, and they took the longest to get back, right? So you got to understand the market cycles and why now are they the high growth markets? Because they were still coming up and still are coming up because they were hit so hard. So it's really important.
I don't know if I would agree with that in terms of Phoenix. Phoenix has a very, very large employment base.
You just said your house, you lost like all the value from.
But I wouldn't say that that's
right?
why. I wouldn't say why they have the underlying factor of why they have the roller coaster. They have consistently, even in the downturn, had a very large migration to Phoenix, of people who are moving there. Phoenix is seen as West Coast, but affordable. Cost of living is relatively low, especially when you compare it to California. I know entire families. Some of my best friends, they're from San Jose and LA. One family member moved to Phoenix. They're like, oh, this is great. We love it here. It's kind of similar to California. And pretty much like 40 other family members, one by one, families, cousins, aunts, uncles, moved to Phoenix because of that factor. So there's some underlying factors there, but I do agree that, they are experiencing, the market cycles more significantly than we are. In terms of, one of your other questions, and I didn't see that there was a chat here. I apologize. I've probably missed a bunch of questions because I did not even realize there was a group chat till just now. Sorry, I'm new to Zoom. But one of the questions that you had is, how can new investors to multifamily use this to get in, right? How can they start investing in multifamily? I'll be honest, I don't think that the answer is any different than before this time. I don't think that the model for getting into any real estate opportunity is pretty straightforward. I think real estate has an established, very clear blueprint for a long time. And if you follow the blueprint, you can win, right? Zach and I were talking, actually Zach and I talk, probably, I don't know, once every other week or so. And I was talking to Zach about this earlier today. I think Zach, fresh out of college, is doing it the right way. And he's following the blueprint.
You mind if I chime in there?
Yeah, go for it.
So this doesn't specifically answer that question about, how can new investors get in? But like today, I cold called for about 8 hours. And usually when I address these owners, hey, can I buy your building? It's a pretty quick conversation, but I kind of changed up my script today to really talk to them about, hey, like, what are you worried about? Right. And used it more or less of a way to help build rapport. And continue to stay in front of them. Hey, do you mind if I share some information with you that I come across, in relation to COVID-19 or some of these things that are, we're seeing with the different loan programs? Do you mind if I share that with you? Do you have an email? And using that as an opportunity to continue to stay in front. They may not want to sell exactly right now, but for somebody who's new and just getting started talking to owners, you can kind of use that as an icebreaker to help get in, as opposed to, hey, when the market's on fire, some of these people who own they have their nose in the air. And Aaron and I talked about this today was, most folks, and sometimes the newer guys who are getting in want a home run deal. Now is the time, go get yourself on base, go get a single, go get a double, and start to learn. While in theory it sounds great, and we talked about this too, to go get an 80, 100 unit property. I just saw somebody post on Facebook. I think, Kent, you were tagged in it. David Tupin was like, hey, I got a 20 some odd unit in Indy. Now, don't get away from your defined criteria, but if something comes up, don't be afraid to tackle it just because, hey, I don't feel like it's going to be a home run.
That's right. I mean, man, I think you said a couple things there that are awesome. One is, you change your script to focus on trying to solve their problem.
Yep.
Right. So you start with what their problem is. And like Aaron said, why do people, the 80% of mom and pops, why do they sell? Right. What was it? Death, divorce, distress,
medical,
So figure out what their problem is and help them solve their problem. Right. So I think that's awesome. I think that's a great approach. And the other piece around, I don't look for home runs. I look for singles and doubles. I tell everybody I want singles and doubles, and I want to stay on base, stay in the game, and just keep rolling. And I think that's the way you got to look at real estate, because try to hit home runs all day. Just all it takes is a baseball analogy all the way. Like, you're going to strike out, right?
It just takes so long to try to, especially if you're not working with, you're not in the space where Aaron is transacting like some of these larger deals and you're having to self-procure. Like, just get on base, right? Learn the basics and use that and leverage those deals. Learn on those things so that when you're, 5 years down the road, 2, 3, 4, however many years down the road, you can say, hey, look, I've already been through this. We've already learned on, a little deal. And now we're adhering to, hey, we have outside investors in on this thing, but we've weathered the storm before. So it's not, it's not a huge hit, if you will.
Yeah. You're talking about building a track record and creating momentum. And when you get to the point where you want to raise outside money, nothing is more important than having a track record.
Yeah. Document it.
Yeah. So that's awesome, Zach.
I would add to that, look, there's a lot of information about multifamily out there. Information is easier to get and obtain than it's ever been, which is a good and a bad thing. Right. The good is that, look, it levels the playing field. The bad is there's people who take advantage of that, or I wouldn't say take advantage, but maybe exaggerate, right, what it's like and what. And
there's no shortcuts. There's no shortcuts. Right?
Yeah, and the number of phone calls that I get on a daily, weekly basis of, hey, I have a mentor. Hey, do you got something off market? hey, I only want 150 units B class with, rents that are under $200 a month under market, are just, it's it's exhausting.
I want one of those. You got one of those?
Me too. Me too. And when I find one,
You're not going to tell me about
we
it,
can
are you?
partner on it.
Oh, perfect. You will tell me about it. Perfect.
But they're out there, right? They are. But here's what I'm finding is that, talking about shortcutting the process, is that they exist. They do, but you have to be ready for them. And most of those people who have never done a deal before are not capable of doing that deal.
Mm-hmm.
And you have to have the track record, you have to have the money, you have to have the balance sheet, and you have to have the relationships to do that deal and do it quickly. Because when a broker brings you that deal, they want to know you could close. Because if you don't, they look like an idiot. And my business is built on relationships, right? And so if I bring a deal and the buyer can't perform on that, then that relationship is ruined and that opportunity is ruined. So
not only that, waste your time. Like,
yeah.
We're like, I'm a broker too. We get paid on commission. So we get paid when the deal closes.
Yep.
So if there's someone with a BS transaction, the sooner we get paid.
Yeah.
The sooner the seller gets their money. Everybody's happy.
Yeah. And the people that, I trust and I've done business with, get called first. And that's being completely transparent, right? I could be a broker that tries to appease everybody and says, oh yeah, absolutely, I'll call you first. Look, I just don't have time to call everybody first, right? I'm calling, look, Mike and I have done a deal together. Kent and I have done worked on a couple deals together. The people who, we don't have to close deals, right? But you have to handle yourself professionally. You have to demonstrate you have the ability.
We're trying.
Yeah, right. You have to demonstrate you have the ability, right? That you have the ability to perform and perform well. And I think that's the key. And so getting on base, as Zach said, I think is crucial.
Yep.
I'm happy to work with, I mean, a lot of the deals I sell are sub $1 million, and sub $1 million is first multifamily territory. And that's okay. So I'm very comfortable and happy. I love helping people get their first deal. But usually those people have said, I got 4 houses, or I've got 5, or I got 6, I got a couple duplexes, and I'm ready for the next step. I'm ready to come up to that next level. Or frankly, those people can say, I've got $400,000 in the bank and here's my proof of funds. Let's go. Outside of that, if you're trying to syndicate a 20-unit deal, and you don't have a track record of doing that, that's going to be a little tougher, and so I think that there's actually going to be more opportunities in the smaller space right now than there are in the bigger space. So I guess coming back to that question is, how can I help this to get started? To get somebody started in the multifamily game is, I think there's going to be a lot more opportunities in those 4, 8, 10, 12, 20 unit deals than there are necessarily in the bigger deals right now, because the big guys are going to weather the storm.
Well, you said it yourself, right? So 80% of multifamily is privately owned. So if
Yep.
you think about some of the, overall mom and pops, they weathered the storm of 2008, right? And they may have been 50s, maybe 60s. Now they're getting up into their 70s, 80s, even later. They just don't want to deal with it anymore. Okay, hey, great. Well, you don't want to take the hit on the capital gains. Well, seller finance it to me, and I'll take care of the headache. I'm the young guy. I'm ready to step in and take this thing over. I want to implement, new systems. You shouldn't be collecting rent by hand. You shouldn't be collecting cash. Let's get these tenants set up on the online platform, right? How are we doing maintenance requests online? How are you, increasing the efficiency of the operation there, but they're still happy. Maybe you don't need to syndicate the thing. You can sell or find. I agree wholeheartedly with you on something like that, because you're having unsophisticated owners who own the thing for 15, 20 years. And they're like, you know what? We've been through 08. We're just kind of done with this whole virus thing. Seal the deal up and get it closed.
Mm-hmm. and I don't want to discourage anybody. I think you should still be taking swings at the home runs, right? The bigger deals. Just don't pass up on, base hits, doubles. There's a, kind of universal law of momentum, right? Law of attraction, whatever you want to call it. Get a deal done. Get 2 deals done, and you're going to get more deals done. And then the bigger deals are going to come, right? But if you're only swinging at big deals, just be prepared to wait, because the home runs don't come as often unless you're Barry Bonds.
Or Grant Cardone.
Asterisk.
Yeah.
Awesome.
Yeah.
Well, thanks, Aaron. This has been a great conversation. I was going to share some stuff with you guys. I honestly think we covered a lot of it. One thing I did want to share with you before we get to going around the horn was National Multifamily Housing Council came out and said that, average collections in April were 69%. So it sounds like people on this call have done better than that.
So clarification, 69% at this point in the and actually as of the 5th of the month.
Right.
Yeah.
Yes.
So compared to 82% of this normal period compared to last year. So they're saying it's 12% below normal collections.
Yeah. Good clarification. Because you're right. It is based on time of the month. But I've heard swings. I mean, I know that we're doing better than that. I've talked to others too that, are 80, 85%. So I think, it drastically depends on asset class and location. And there's a lot of things that come into that, but yeah. So overall, I think the point is it's not as bad as I think people thought it was going to be. It is down, but I think people are weathering. But I do agree that I think May, June, et cetera, I think things probably do get worse before they get better. We already talked about payment plans and things.
And one thing you mentioned about just asset class, right? I personally, this is just personal opinion, I think B class is going to weather the storm the best.
I do too.
A class, we've already seen rent declines in A class. A class was already struggling with lease up. Yep. Now here's actually clarification point. You asked where the opportunity is. It's an A class. Problem is most of us can't afford A class. If you can swing,
or you want cash flow.
Yeah. Well, I think that there's going to be A class is the one that's going to, if they're not already doing well, they're the ones who are reducing rent to just get lease up. I'm aware of several A-class deals that are not even at 70% and they've been on the market a year or two. They're struggling. So if you can get a $20 or $30 million deal done, that might be where some opportunity is. Most of the time, they're going to go to the sure thing. If they're going to sell it at a discount, they're going to go to the guy who can come in all cash and can get that deal done. I think there's opportunity. B is going to, we'll come back. We can bookmark this and, and hold it over my head later. But I think B class is going to weather the storm the best. I think C class will feel it early, but will level out and be fine once this bandwidth issue with unemployment and things like that are taken care of. C class is going to be just fine. You've just got to get through this temporary bandwidth issue for the government to get the money out to them, and then you're going to be fine.
Yeah, no, I agree with you. I think B class is going to weather it the best. I mean, I've always liked B for that just the sheer fact that it sits between A and C, right? In bad times, people move from A down to B. Good times, people move from C up to B. And usually they're a little bit of a newer asset, so you avoid some of those maintenance issues, especially if you buy something that's post 1980, right? One thing I wanted to bring up was just, I do think that we're in we are in a whole new world. I mean, we're going to get past this, but the likelihood of a pandemic happening again, I mean, it's a real thing now, right? Like nobody thought it could happen. It did.
Well, we've already had 4 before this.
Well, I know, but it was like, 1900 and 5% of the population died and nobody thought it could happen again. Right.
Yeah.
In this day and age, but it has. So I think it's important for you know, whether you're investing passively or you're investing actively, I think it's really important as you're talking about doing underwriting, you're stress testing your deals, and the things that I think it's important that you're looking at are those more conservative metrics on, you know, bad debt, occupancy, debt coverage. So, you know, and underwriting, not just for long-term changes, right? So okay, maybe bad debt is a little bit higher, you know, forever, but I'm saying more like, what happens if bad debt goes to 20% for 3 months? You know, what does your deal look like then? Does it still pencil out? Does it still make sense? So I think expanding the outer bounds of how you would, I mean, hopefully you're stress testing already, or if you're investing passively, you're asking your sponsor, how do they stress test? But basically it's saying what could the occupancy go down to, right? And you can still pay your mortgage. You know, what's your break even point? You know, what happens if bad debt spikes? You know, and follow your debt coverage and know, you know, when do you hit a 1%? Can you, like a deal that where NOI can only drop 10 or 15% and you're at a 1.0 debt coverage. I mean, there's not a lot of room to breathe in that deal versus a deal where you could go, you know, 25 or 30% drop. So I think taking those things into account, I mean, I'm even seeing it in the marketing that I see go out for other deals. It's funny, like right after this COVID thing happened, I saw a deal come out and the headline was talking about their high debt coverage ratio. I mean, not IRR, not cash on cash. It was, look how high our debt coverage is. Like we've got so much room. It's so safe. But I do think it's important to take those things into account. So I wanted to plug that, and make sure that, you know, you're focusing on. I think the other thing is I don't think rents or expectations are going to be right. Like people expected rent to grow at 3% plus forever. That's not going to happen. I know that we're not planning on raising rent for at least 6 months on our properties, you know, potentially a year. So we're going back to the underwriting and saying, what does that do? Now, if you're looking at a 5-7 year hold, which is what our plan was, it's not a huge blip, or it's a blip in the overall, you know, maybe it's 20, 30, 40 basis points. But if you got a shorter term deal, I mean, it could really impact things. So I think looking at that, just make sure when you're looking at deals, you know what the downside is, right? Because nobody thought this could happen, but it did. And it's probably going to happen again just because the virus is out there now. And, you know, like the flu, it could come back.
One thing that you mentioned, I think is very important is, you know, when you're looking at opportunities and deals, it's your perspective, right? Real estate, you can make a lot of money in a short period of time, but it's not a get rich quick. It's a get rich opportunity, right? It's not necessarily quick, but you will get rich if you stick to the plan, right? And so, especially with multifamily, I mean, there are certainly opportunities to flip deals and make some good money real quick. But if you want to get rich and not just make a few $100,000 quick, you need to be looking at your deals from a long term. And I think this, in the big picture of things, we'll look back and everybody will cringe and that'll hurt, right? It won't be a fun time, but it will be a blip, right? It's a moment in time, and you have to be looking at the larger benefits of owning the real estate long term and controlling that. Because think about the opportunity cost of, if only so many deals come on the market every year, every decade, and you can only get X% of those, controlling that over the next 10 or 20 years, what does that mean long term versus, you know, over 6 months, right? And so having that perspective and the long-term benefits, we have to maintain that perspective of what, especially for multifamily, of what multifamily is and what it's meant to do, right? It's long-term.
Hey, Aaron, have you had anybody talk about escrowing in your deals to guarantee income over the short term? Do you guys have people doing that?
One deal so far, one deal. And that's a student housing deal. And student housing is a different animal. So I've got a $5 million property in Lansing, Michigan, brand new 2016 construction, Class A. They're leased up for the next year, but with university sending everyone home, the buyer's concerned that they're not sure if the tenants will be there next year. So that deal in particular, because it's not conventional multifamily, the buyer, that deal did die. It died temporarily for about 48, 72 hours until we got the seller to realize, hey, look, you either do this or you don't sell your property. This is going to be, for student housing, a regular occurrence. And he guaranteed, what we did is, so the structure we set up was, if income falls below 90% of collections, we'll have an escrowed amount and they'll draw that down. Up beyond that. Now, on the opposite end of that, if collections are above 95%, that's credited back to the escrow amount.
Interesting.
So, we got creative there. It's a win-win for everybody, and it gives them the assurance, the buyer, the assurance that they need without, penalizing the seller too much.
Yeah, I just brought that up because even in normal multifamily, we're working through a deal right now that actually just fell out. What we let die in it's going to be in Kansas City. I think it'll probably come back, but it died over the escrow. We were talking about wanting an escrow, and I think we'll get it. But I know a couple other operators I talked to that have been doing that too.
I think that's happening in the more sophisticated space more often.
Yeah.
Right. If you're doing larger deals, I definitely see that happening more. In the C and B class mom and pop owned properties, I'll be honest, that's a tougher sell.
Yeah. I mean, I think you're right. Right. Like, yeah, the people that we would be buying from, it's another syndication group. So, I mean, they're, like you said, a little more sophisticated. I think it's,
if someone's transacting, they know they know the atmosphere, the environment that things are going on right now.
But I think it's like, my whole point is, I mean, you can get creative in this time to add protections for yourself. Right.
Yeah.
And I think what you described, we didn't have the provision for it to share in the upside, but that it could be a good win-win, and that could be a way to get it over the line and get the deal done. And you're kind of creating, some guardrails around that. But I think that's a way to continue to do deals. And if you're feeling worried, to give yourself a little safety net, but just look at escrowing related to certain metrics like NOI. Cool. Well, I wanted to just go around with you guys. I'd love to hear from everybody. 90 seconds, doesn't have to be anything crazy. We'd love to hear who you are, where you're from, what you focus on, if you own or what you're looking to buy, and what are your goals? What are you working on? And then, go as long as you want, but love to do that. Maybe it's probably hard. People are probably in different orders. I'll start real quick. You already heard from me a little bit, but so, like I said, Kent Ritter from Indianapolis. I'm a multifamily syndicator. I've had a pretty busy month, even being home most of the time. But I've worked out a deal with a firm in town. We've been negotiating for a while, called Burge and Held here. It's a large operator to partner with them on some future deals. So I'm excited about that. I'll be helping them raise some capital. So I think that's going to be an exciting opportunity they've got about 11,000 units. So they're a very strong partner to have in uncertain times. So that's kind of how I looked at it. So I think that'll be great learning experience as I continue to educate myself too. I mean, I've only been in this game for about 4 years, so I don't by any means pretend to think I know everything. That's why I like doing this, because I learn something every time. So that's going on. So we finally got the ink on that contract through the negotiations. Also working on starting a podcast. So way more work than I ever anticipated doing that. But I've got 3 interviews done now. I've got intro, outro, graphics, all this stuff done. Hopefully launching in the next 2 weeks, getting final editing done on the first 3 episodes. And a lot of my things I was mentioning or takeaways came from my conversations I was having with other operators through those podcasts around, COVID and how they're dealing with that. So really excited to get that out. Other than that, I'm still looking for deals, on my own as well. Looking for the right ones to come along. I have, the last deal that I syndicated, it's been a while now. I mean, it was October, so I guess 6 months. It was 250 units, but I recognize, like Aaron said, that there's a lot of opportunity in the smaller space. Now you get 100 plus, and the competition is so thick, and we got to the point where cap rates were just, you're paying a sub 4. So I started looking at the discrepancies in deals that were smaller, and while you don't have all the efficiencies, you could get a 6-7 cap. And still have a really nice property that cash flows. So I've started looking a little smaller, and I think there's good opportunities out there. So continuing to look, but yeah. And other than that, besides that, I've got a wife and 3 kids, 3 under 4. So I do that all before they're awake and after they go to bed. So yeah, but it's fun. Luckily, I have my own office, which is where I'm at now. If I didn't have an office, I don't know how I'd be able to survive. Cool. Well, Zach, you want to go? You're to the right of me on the screen, so I'll pass it off to you.
Cool. I have everybody vertical. Just like you, I'm from Indianapolis, born and raised here. For the most part, I just do residential and some small multifamily brokerage. Nothing like Aaron over there, but who knows? Maybe we'll work together on something one day. He's pressing me a little bit.
Been trying to get Zach to come over for a while. We'll see if that happens.
But like Aaron had kind of mentioned, I started in the single family space and have since kind of moved to smaller multis, and for the most part doing joint ventures. I don't have a ton of liquid cash available, so I have to bring other resources to the table and continue to look for more opportunities in the smaller space in and around Indianapolis. Have found some success there, but there's not always as many operating efficiencies as probably what you'd like, but it gives me an opportunity to learn. And so looking to expand that and some of the brokerage business I'm doing. So I hope that works for you.
It's great. Thanks, Zach. Bill Thorne, you want to go?
Hey, thanks for having us, opening it up. Bill Thorne, San Diego. Been investing for about 10 years in multifamily here in San Diego. Luckily, I sold 3 of my 4 buildings in the last 9 months. Otherwise, that'd be a lot scarier deal. So far here, I think we're going to get hit a little bit harder just because our rents are so much higher. I've got one building left, C class, and some of my rents are $1,650 on that. So their $1,200 payment from the government's not going to go very far.
Yeah.
So far I've had good collections, but like you guys were talking about, I think May and June are going to be a little rough. So we'll see how that goes. In the Arizona market, haven't really slowed down. We've been putting a bunch of offers in on both mobile home parks and multifamily in Tucson and Phoenix. Still, things are going for usually over list price. So I haven't seen any any concessions yet from the sellers. So still going after it though.
What size are you looking for out there, Bill?
Anything. The parks, they're up to 100 lots. Multifamily, up to like 4 million right now.
So Bill, I'm familiar with what multifamily goes for in Arizona, but what does it go for per pad and mobile home parks in Arizona?
Like 25 to 30.
Really?
1,000.
Wow.
Yeah.
Because I'm just surprised because in Indiana they go for about 20 to 25. Well, you can find them for 15, but I would say average is 20 to 25. So that's not, from a mobile home perspective, that's not too different per pad.
Yeah.
And you're probably getting stronger rents in Arizona. So
yeah, it's still a crazy market out there. So a lot of competition.
Right on. Alfredo, you want to go, man?
Absolutely, yeah.
Thanks.
Well, thank you everyone for the invite, and it's good to meet new investors. I actually invest in the Midwest, actually in Louisville, Kentucky. My partners and I have a couple of properties there, and we been looking for a while to scale up. And as you know, the market has been tough there, but been also looking in southern Indiana, and so it's been a little bit tough there, but the opportunities will be there soon, and we'll be ready. As a matter of fact, I was planning to travel there next week, but when everything happened, we put it on hold. I was going to meet with several of my partners there and take a look, visit several brokers and property managers in the area, and just to build a relationship. So, Aaron, you were on our list,
Well, we'll have to do a rain check, and we'll definitely connect. I know you and I have, you've made some offers and we've communicated on some deals. So I'd definitely love to connect with you when you're in town.
Yeah. We talked for a while, and
Where are you from, Alfredo?
I'm actually in South Florida. I'm in
nice.
close to the Miami, Fort Lauderdale area.
Very nice.
Yep, I do have some friends that lives in that area in the Midwest, so that's the reason I like the area. I like the market there. Good area to invest. So,
what kind of properties do you have in Louisville?
well, I have a Class B, 48 units, and also a Class C at 12 units. Yeah. So
very nice.
They do cash flow very well. And it's been, a learning process to invest outside of the area where I live, but it's been challenging at times. But it's a learning process that you go through, and there are several people down here that they like to invest up there in the Midwest, so. We're ready, just waiting for the right deal.
Gotcha. And you said you're looking in Southern Indiana too. What areas of Southern Indiana are you looking in?
Well, just across Louisville,
like Jeffersonville and
Clarksville,
Clarksville,
New Albany.
Yep.
Yeah,
okay.
that area. We recently looked at a deal in Scottsboro, I think it was. Yeah.
Oh yeah.
Yep.
Yeah.
Was that Aaron's deal?
It was, yeah.
It was? You don't remember?
It was.
I see. Okay.
He's like, oh, okay. Well, thanks. Thanks,
right,
Alfredo.
well,
nice meeting you, man.
Nice meeting you all.
Mike Montana, you want to go, sir?
Sure. Just unmute me here. So I'm in Indianapolis. Been here in the Midwest Indianapolis area for about 25 years. Originally from Orlando area, Florida. Been in multifamily for about 20 years here in central Indiana. Small multifamily, started in duplexes and fourplexes, and then scaled up to like 15, 16 unit properties. Actually met Aaron through his colleague Austin, who relentlessly called on me about selling a property for probably a year, and then we actually listed one with those guys a couple years ago, I guess, and then we bought a property from Aaron in the past year, I guess 9 months ago or so. We've done most of the deals with our own money so far until the most recent purchase, which was syndicated. We syndicated that deal. What we're looking for is really small, mid-sized multifamily. We like the probably 50 to 150 unit deals. Central Indiana down into Louisville. We've offered and actually had a couple of different deals under contract that didn't transpire in the Louisville market, as well as Cincinnati. We like Lafayette and Bloomington as well. We do a little bit of student housing. We like that market. Actually, a lot of people are scared of it, but we're growing more and more fond of the student rental. Maybe challenging this fall, we'll see, but I think it's all going to come back if you're in the right market. So,
so
that's what we're doing.
What'd you guys do with your student rentals now that the students aren't there? What's happened to them?
So they're still fulfilling the contracts.
Okay.
We have made a few alterations to contracts going into the fall that have a little bit more liberty for the resident or for the the leasee to get out of the contract if school doesn't transpire in the fall.
Mm-hmm.
So it allows them a little bit softer out. But the reality is and we've heard this from a few of them already, which is if I don't have one in the fall, if it doesn't start in the fall and it's going to start in the next semester, I still got to have something secured anyhow. So it's kind of it's a good business. We think it's a good space to be if you're in the right markets. Lansing's a great market, right? Those Big Ten universities where they're not going anywhere.
Mm-hmm. So you guys looking to acquire more student housing then? You're looking at more Big Ten schools?
We are, yeah. We mostly here in the Midwest, Central Indiana. We have a couple Big Ten schools here, but I think in the right markets we'd be interested as well.
Cool. Awesome.
I apologize to cut in. I do need to run, but I appreciate everyone's time and the participation. Kent will share my information with everybody. If anyone would like access to that document that I'm going to share with all the resources, feel free to reach out to me offline. And it was a pleasure meeting everyone.
Awesome. Thanks, Aaron. Appreciate it.
Thank you.
Thanks, Aaron.
Justin, you want to go, man?
Yes, I'd love to go. Hi. So I am Justin. I'm actually similar to Mike. I am from Orlando, Florida. I moved up to Indianapolis for full-time position. I actually work in the medical healthcare industry. And then on the side, I do real estate investing. So I'm kind of getting my feet wet. I've got a duplex so far. I've been at this less than a year, just kind of consuming content, going to meetups, whatever I can do to learn more. I'm young, don't have a lot of liquid capital. I know that Zach mentioned that, and so I'm kind of trying to find creative ways to get these deals under contract and start building up more properties. So that's a little bit who I am. And then kind of, if you're wondering, I had a mask on earlier. I'm actually at work right now. So I shifted to like an evening shift so that during the days I can be grinding it out on the streets, doing looking at new properties, analyzing deals, like during the time that all the other real estate professionals are kind of working. So that's a little bit about myself. And, thanks again, Kent, for putting these on. And they're super informative, and they're, definitely helping me out in my journey. So thanks.
Oh, good. I'm glad to hear that. Yeah, keep grinding away, man. That's awesome.
Yeah.
You're working double shifts every day.
Yeah.
It'll pay off. Cool. Thanks. Who's up next? Alfred. Max, you want to go? Max, you there? Maybe not. Gwaith, you want to go, man?
Yeah, can you hear me?
Yeah, we got you.
All right, man. I'll try to put my video on. I've been bathing kids and whatnot, so saved you guys the visuals there.
Yeah, we got
you. So Gwaith Smith, I've been investing for a few years now. I got property in Pittsburgh. I've syndicated and co-sponsored some deals in Texas. I got to connect with Alfredo because I'm also in Jeffersonville, have a 42 unit there, and have been focusing on that Southern Indiana and Louisville market for about a year now. So, my goal and strategy this year was really to do 100+ unit in that market. Bringing money in, syndicating like some of the deals that were done in Texas, but really being the lead on it. I sort of switched up that strategy given the current situation. I'm not a doomsday guy by any stretch of the imagination, but I do think that the global economic impact is going to be a little bit worse than maybe what we spoke about on this call, at least. I'm in New York. I'm in what would be considered, an affluent area, and there's shops boarded up. I mean, we're losing a lot of small business here. We're losing a lot of restaurants. A lot of places are closing down that I don't think are going to reopen. And I think that, I think not to the extent that it's affected New York, but I think that it is going to start spreading, I think, from the coast more towards the center of the country. And and right now, for instance, I know Boston's getting kind of hit a little bit worse than they had been. So I don't think it's over. I think New York's plateauing, and I think that's a big reason why we're seeing some of the, some of the bumps in the markets and whatnot. But I do think that we're not out of the woods just yet. So with that said, I switched up my strategy a little bit. I've been in contact with my brokers and my lenders, and also have some guys that maybe want a JV on some stuff. So we're looking at more at that 50 plus range now, where we can come in not as a syndication, but with, a group of guys that are looking to come out of this a little bit stronger than they went in. So that's where my strategy is right now. And, just kind of keeping the head down, not staying on the sidelines, still being active and seeing how we can, I think take advantage is the wrong word, but to just come out of here stronger than we came in.
Yeah, absolutely. Hey, did anything ever come from connecting with those guys I hooked you up with, those guys from the Best Ever conference? Did you talk?
No. No. So we had like that little intro email, and we spoke over email right thereafter, but never connected afterwards. And part of that's probably on me. I need to get back to them and see what sort of resources that they could be.
Yeah, it was just curious. Like for everybody else, I met these guys at the Best Ever conference, which is Joe Fairless's real estate conference, and they're, essentially they provide like back office services. They kind of provide the whole back office and like structure for syndicating a deal, and they'll also bring money into the deal. And they're like, I think they've done. They look at smaller tertiary markets, which is interesting. I knew Gwaith was in down there in Jeffersonville and looking at Southern Indiana, so I tried to get him hooked up. But it's just interesting company, interesting business model. I can't remember the name off the top of my head, but I had never seen anything like that before. So just
I
curious.
have to go back and look.
Yeah, well, good, man. It sounds like how's your deal down there doing?
The Jeffersonville deal is, we're hanging in. So, that of all my deals, that's probably the one that I think is going to be hit the hardest here. And the reason I say that is because it was our heaviest lift. So we were coming in with, delinquencies off the bat. We were coming in with a little bit of a heavy lift and doing some renovations and whatnot. So a lot of that stuff got put on hold. When COVID-19 hit of 42 units, we were trying to fill 6 of them. With that said, it's really hard to show and fill units right now, especially if you projected rental increases and whatnot. So we've actually, like you were saying before, on the renewals, we're saying that we're not gonna shoot for a rental increase in the renewals. The turns, we're doing more light turns now than the renovations that we had been planning. But right now it's a little bit of a wait and see. Where
sure.
We have some lender required repairs, but understandably so, residents aren't wanting contractors in their units right now. So
sure.
Working with the lender to kind of alleviate that. And one thing I will say, because I know the conversation started earlier, I have reached out to our lenders, and I know somebody had said that there might be a blacklisting of sorts on the Freddie Fannie side of things. What I was told by my lender is that they're really kind of writing it that they can't do that, and you can't be penalized for requesting or taking forbearance. But what they'll do is anybody who's going to apply for a loan later on, the underwriters are going to use the narrative of saying that these guys were owners during COVID-19. They didn't take advantage, or they didn't use the forbearance that was offered to them. And they're going to use that to really sell the buyers that didn't take advantage of it, as opposed to using it as a negative for those who did.
Interesting. Well, thanks for that perspective. Yeah, I hadn't heard that. That is interesting.
Yeah.
Cool. Well, thanks, man. Appreciate you sharing.
Yeah. Hey, I appreciate you for putting this on, man. Really informative. Thank you.
Awesome. Well, yeah, it's great to connect. It's nice to be able to bring people in from around the country. It's kind of cool. Mm-hmm. Mike Constantis, you want to go? I think I just butchered your last name, but you want to go, Mike?
He was texting me. He's one of my partners, and I think he said that he had some bathing duties ahead of him as well.
Okay.
He's got a couple kids too.
Right on. How about Chris? You there, Chris? Chris Weiser?
I am. Can you hear me?
Yeah, we got you.
Great. I'm actually Gway's other partner with a 42 unit in Jeffersonville as well.
Oh,
So this is like a good little, like a little family get together in Jeffersonville, Indiana, and Kentucky over here. So nice to meet all you guys. I live in Houston, Texas, and we're getting hammered by the Saudi Russia oil prices, wars over here, and the COVID stuff too. So it's a lot of fun. I've been in real estate for about 8 years, investing passively. I think I've around 700 doors right now as a passive investor. And the property we closed with Gwaith and Mike and our other partner, this is our first active purchase, 42 units. So it's been a good eye-opening and learning experience. And it's nice to kind of be in the fire, learn the nuts and bolts versus just kind of knowing all about the plane, but never have flown one, kind of, so to speak. So that's been fun. It's a good challenge. We're trying to manage that as best we can. We're still actively looking for more good deals right now. As Gwayth mentioned, 50 plus units. We like the Louisville market. We like Southern Indiana. We're trying to identify a couple of other markets maybe that are close by too. Midwest is a pretty good area for us, it seems like. So still kind of working through that, what to choose right now, but learning as we go, man. It's been a fun challenge.
But you're in the game, right? We're talking about hitting those singles and doubles, so
that's right.
Perfect.
We got a bunt.
You're button, yeah. Hey, still get on base.
That's right.
Awesome. Well, thank you guys for joining and sticking with us to the end. I appreciate it. It was great to hear from everybody. Really nice connecting. I mean, it's good just being stuck in the house just to see some faces besides my wife and kids, even though I love them. I do. It's nice to get to connect. So appreciate you guys all joining. We're going to do the same thing next month if we're still stuck inside, which we probably will be. So we'll do the same thing, hopefully get together. I'll rustle up some more good guests for us. But thanks, guys, and enjoy the rest of your evening.
Thanks, Kent.
I'll make sure we get all the content out as well. And I'll get Aaron's contact information, that document he was talking about. I'll make sure we get it out to everybody. So we'll see you guys later.
Thanks a lot.
Take care.
Thank you.